Chapter 14, Computations and Title Closing. This is a lot of math. To change decimals to percentages, that's pretty easy. 0.5 would be 50%, 0.2 would be 20%, and so on. Changing percentages to decimals, 34% would be 0.34, 150% would be 1.50. Sales commission: if the broker has been hired to list and sell property for the seller is normally responsible for paying the commission. Percentage applied to selling price, cost, and profit. Profit is how much you make over and above your cost. Mortgage amortization. Mortgage used to purchase residential property usually call for regular equal payments that include both interest payments and payments on the unpaid balance of the debt principal. This type of mortgage is called level payment plan, more commonly a fixed amortized mortgage. So in your first month you would pay $20.13 on the principal but $200 on the interest. In the second month you would pay $20.26 on the principal, a little more and a little less in interest, $199.87. On the third month, you would be paying $20.40 and an interest of $199.73. So you start paying a little bit more on the principal every month and a little less on interest. Prorated expenses. To prorate means to divide various charges and credits between buyers and sellers. Every sale contract should specify a date and time for prorating items. Taxes are paid in arrears, that is, at the end of the period for which the payment is due. In a 365-day method, say from January 1st to December 31st, on a closing date that is July 23rd, and we are trying to calculate the proration here for the mortgage. So pretty easy is the buyer owns the day. You just got to know that the buyer owns the day, which would be July 23rd. So they would own 162 days. And we know the knuckle method. January, every other knuckle. Start with the first knuckle. You got January's 31. Every knuckle's the 31st. January, February, March, April, May, June. July's 31. August is 31. September, October, November, December's 31. Pretty easy. So you just have to prorate that month and figure out how many days you actually own and figure out the rest of the days. Prepaid rent. You got the 1st and the 30th. The closing date is on the 21st, so you own that day. It's not 30 minus 21, which would be 9. It's from the 21st to the 30th, which would be 10 days. Mortgage interest on assumed mortgage. Mortgage balance times annual interest rate divided by 12 months is the month's interest. Month's interest divided by days in the month is the daily rate. And daily rate times days interest is owed is prorated interest. State documentary stamp taxes on the deed. The state documentary stamp tax on the deed is assessed at the rate of 70 cents. For each $100 of the full purchase price, or any fraction of 100. So for the deed, we got 70 cents for every 100. For the stamp documentary stamp tax on the note, the state document tax on the note, we tax it 0.35 for every 100, or a fraction thereof. So deed 70, note 35, 0.35. State intangible taxes on the mortgage. The tax rate for the state intangible tax on the new mortgages, this is for new mortgages, is 2 mils. So that's 0.002 cents on a dollar, or 0.2 of 1 cent per dollar of debt. $25,000 new mortgage, you'd be paying, you'd multiply that 0.002, you got $50 tax on second mortgage. This is all a lot of math. Basically, you got to review all the math, make sure you have it down, That's chapter 14 in a nutshell.